I want to welcome everybody to our Practicing Sound Loan Management in a COVID World webinar. It's a mouthful, but we're going to make it very, very practical for you today. Allow me to welcome Robert Inskeep, Bob Inskeep, who is with us. I'm so excited to have Bob with us. He has over 33 years of hands-on experience as a national bank examiner at the OCC, at the Office of the Comptroller of the Currency. After that career for the next 13 years, Bob is an industry consultant. His primary focus is on key risk areas: credit risk, operational risk, compliance risk, liquidity risk, vendor risk. And I'm so thrilled to have him because he will cover regulatory requirements, expectations, challenges, and what an OCC examiner is looking for and what lenders should be doing for their audit. I think our presentation is going to be perfect because Bob is going to cover that very strategic and important, what to do, what to look for, what our examiners looking for. And we have our own Rick Vanko with us, who's been with Wolters Kluwer for over 28 years. Rick is going to bring his practical knowledge and expertise of what our customers and lenders are doing today in the COVID world to be able to comply with the regulations, and tactically, what do we do with our auto lending portfolio today? My name is Marina Hardy. I'll help moderate today's webinar. We'll cover what the vehicle lending looks like, what to expect, and how COVID-19 changed regulations. We'll have practical advice for you, talk about impact of repossessions on how to address exceptions.
Thanks, Marina. Welcome, everybody. Let's turn to this landscape that we've talked about in the first part of the agenda. And you all probably know this much better than I do. But this tremendous increase in growth in lending, particularly cars, trucks, and SUVs, that's phenomenal when you think about in a decade and then what the base was to start with. As we all know, I think that when growth occurs, I've seen, and this is on an individual bank basis as well as collectively, there's usually increased risk. Well, auto debt now is at a 90 days past due delinquent rate. It's pretty high, and it's going to get higher. 5.3%, in fact, was the maximum delinquent balance for 90-day paper at the end of the recession. So we'll see what happens. I think we can all guess it will probably get higher. A couple other points: securitizations have become much bigger players. Some of you may deal with this. Just like real estate market grew that way, so has auto lending or vehicle lending. So the point I want to make here is that, and as I would suspect most of you know, particularly ones who deal with securitizations, that does present other challenges when it comes to modifying and working with borrowers. So just as another potential risk that you deal with as you see this pandemic continuing. And then the question we all have is what is going to happen once these, and I think at the end of July was the end of the $600 a week extra pay to individuals. Depending on what happens with any further legislation, any further benefits, we're going to see some changes, obviously, and some potential delinquency changes as those benefits expire. So that serves as the backdrop. What I'd like to do now is just speak briefly to this interagency guidance, which we have posted for your benefit. If you haven't had a chance to read it, I would encourage you to do so. It is a fairly lengthy document. It considers more than just lending during COVID. I'm going to focus just on a few points that I believe are worthy of comment today. And this is, I'm going to give you my 2 cents of what this document says. Being a part of OCC and going through the oil crisis, the real estate crisis, and seeing what examiners did in response. I had retired by the time the recession occurred, but my sense tells me, and for those of you who are familiar with this, I would love to be able to hear your opinion, is that expectations overall for how you manage your loan portfolios, COVID or not, are about the same. There's recognition in this guidance that says we expect, as always, bankers to work with their borrowers particularly in times of stress. That's just part of what you do. Encourage risk mitigation strategies. At the same time, knowing if there are issues when collateral values decline, which is what may be the case, but maybe not too much, we'll see, that may not be the only reason the examiner uses for downgrading the credit, as long as the repayment ability of the borrower is still in place. So there's several parts of this document, and I'll read one that I think kind of captures it. It's page 5, that I think help put it into context. Examiners will continue to assess credits in line with the interagency credit classification standards while recognizing the constraints posed by the pandemic. For instance, supporting file documentation may be limited due to unusual circumstances caused by the pandemic. When assessing asset quality, examiners should consider whether management has been able to identify loans and investments substantially affected by the pandemic and recognize any deterioration in a timely manner, including any potential loss exposure. That tells me it's business as usual. There's no reason to change your view of how you review credits, how you classify credits, how you put credits on non-accrual, how you value the collateral. All pretty much expected. Why would you change? That is my take on that. And again, if there are questions, I would love to hear them. I'm not an expert on that guidance, but I've read it enough to get a sense, and I've talked to a couple of people about it, so hope that helps. There's other guidance out there, and I won't go into it. We don't have time. There is an interagency statement dated April 7th, and it's on loan mods and reporting, long title for financial institutions working with customers affected by the coronavirus. Know that exists as well as some others, and I suspect those of you who are actually involved with dealing with loan mods obviously are should be aware of those. The Federal Reserve has several on their website. So that's where things stand, in my opinion, and hopefully, if anything changes, you'll see examiner guidance or interagency guidance or bank guidance come out. But that applies to all insured institutions, including credit unions.
If we don't adequately prepare, if we don't follow guidance to the T, what are the consequences? What are the challenges for credit practices that are not according to best practices?
Yes, and thank you all for the survey results. I will get to some more points later about what I would suggest to do, but let's talk about, and some of you may be closer to examination activities than others. For those who are, hopefully this rings true. For those who are not, maybe this helps you understand kind of where examiners are coming from. In my career, what we would normally do when we walk into a bank is and start digging into the files, or I'm just using credit as an example, and we found issues with poor originations, poor file documentation, poor loan administration, failure to properly monitor credit and perform collection activities. We would probably, if we were kind and gentle, and I think that's probably, hopefully, the environment today, we would say, get this fixed. You need to, we suggest, we recommend you do this. This meaning these itemized points made in the report of examination or supervisory letter. And by the way, OCC, Federal Reserve, and most of you probably know this, OCC, Federal Reserve, FDIC, all pretty much are in sync when it comes to what expectations are. At least that was my experience as an examiner, and I still feel that way. Some may be a little harder than others, but usually the tenets of what is needed pretty close to being across the board, because a lot of things being done today, as you see, are interagency guidance type related. Matter requiring attention is the first thing you'll see in the report that absolutely says to the banker, you've got things that need to be fixed, and we're going to see to it that you fix them in a period of time. MRAs, hopefully you don't have many. Some of those are perhaps more critical than others. For instance, if one MRA says, in 30 days, you need to get all your collateral documentation up to date, could be a little different than within 30 days, you need to change a policy. Just a good example. MRAs usually are pretty serious. I shouldn't say usually, are. If not complied with, and I've seen this happen time and time again, a bank makes promises, it's not able to correct it for whatever reasons. A year or two go by, the examiners lose patience and aren't convinced that management has ability or willingness to do anything about this issue. Could very well slap an enforcement action, informal or formal, on the bank. And the one I sent you an example of an administrative action on the Mutual Savings Bank in Hartsville, South Carolina. And it's interesting. This is just earlier this year. And if you haven't had a chance to review it, let me just briefly, and I think this is important for this group, the excerpt from this February 26, 2020 agreement. I've highlighted it in your version. Article 7 is about credit underwriting and administration. So you'll see that the underwriting administration should include, at a minimum, policies that address acceptable loan types, terms, covenants, concentration limits, and collateral requirements and exceptions, very much in tune with what we're talking about today, that Rick's going to talk about later. Procedures to identify and track all exceptions, efforts to mitigate or cure exceptions, including but not limited to financial exceptions, collateral exceptions, policy exceptions, underwriting exceptions, goes on. And the number of loans with exceptions and the aggregate dollar value shall be reported to the board. I mean, this maybe obviously was something that probably wasn't happening at this bank. There's also, this is a very important one, and this gets to that point I've got below. This point I've mentioned about imposition of restrictions. Effective as of the date of the agreement, the bank could not grant, extend, renew, alter, or restructure any loan without documenting with adequate supporting material the value of collateral and properly perfecting the bank's lien on where applicable. This is right away making a very firm statement about what the bank can and cannot do. You've seen that otherwise in the press in the last several months about banks being told what they can and can't do. So suffice to say, I believe if I asked for a show of hands right now, I would not expect everybody to have an enforcement action on their bucket list. The last thing I'd want, in fact, what it does is basically ties you down so tight in terms of what you have to do that it probably, and I've seen this happen, it doesn't allow bankers time to do their own work. It's such a rigorous process that's really closely watched by examiners so things don't get worse. Just what you expect coming out of a regulatory agency today or at any point in time. The other thing I want to mention is there is a document I've placed in the same folder. This 12 CFR Part 30. If you're not familiar with it, I would encourage you to spend some time on it. This Appendix A gives the regulators a chance to it may give them a chance to jump right into what we call a disposition letter for action. And this, once banks are found to be violating aspects of 12 CFR 30, it can go right into a cease and desist order if not complied with. Again, this appendix has requirements for standards for managing assets, including it requires adequate procedures to safeguard and manage assets, loan documentation, a separate section, enabling the institution to make informed lending decisions and to assess risk as necessary on an ongoing basis. In other words, documentation that does this and practices. Identify the purpose of the loan, the source of repayment, and assess the ability of the borrower to repay the indebtedness in a timely manner. Ensure that any claim against a borrower is legally enforceable. I mean, that makes it pretty clear. Liens are important. Securing liens. Demonstrate appropriate administration of non-treated loan, and then there's another whole section on credit underwriting. So let's just stop with this and say, hey, and hopefully this is not something most of you have to worry about. But the consequences, it doesn't take much for examiners to begin wondering if the bank is capable of managing its credit risk. The other risk I want you to obviously be aware of is reputation, compliance, and legal. By all means, and if this is not going on, I would strongly encourage, I got to believe it is in your institution, but if there's not a lot of dialogue and ongoing coordination and planning and strategizing between your credit risk folks and your compliance department or compliance risk officer, that needs to happen. I've seen too many times where there's not, the silos exist where they just absolutely are a hurdle that shouldn't be there, so that when the credit folks get ready to introduce a new product or send out a new solicitation, the compliance people in legal need to be hand in hand on every aspect of it, including what goes on with collections and repossessions. So enough said, I think, about this. I think I was a little bit into the preaching mode, and I'd rather be in the conversation mode. So
let's talk about practical advice for lenders.
yeah, so some of this, and this is my last slide, is going to relate to this poll, right, to the survey. Things that I believe, and these are 7, I could probably come up with 12 or 20, things to do to make sure you're ready for an exam, things to do whether you're having an exam or not, just like I said earlier. Collateral management strategies, it's block and tackling, folks. Just like putting your loan file together, I used to pick up a loan file of some of these big banks, and it was papers just thrown into a folder, and I'm going, I don't understand how you're supporting this credit. Make it easy for yourselves, make it easy on the examiners to know how you are doing, what you're doing to make sure your liens are perfected, your assets are properly valued, and not a financial statement number, particularly for large assets, an appraisal. And I suspect some of you all or everybody's doing that, but again, be ready when it comes to that. Clear, and obviously part of this webinar, major point of collateral management practices. If your company does not have what you would consider a sound, thorough, honest, strong quality control function within credit, as well as a second line defense credit review function and internal audit functions, then by all means, it's like going to the doctor again. It's for everybody's benefit if those functions help you do your job, pointing out things to you that may not be what they should be. Clear as that. Everybody's on the same page, right? We're on the same team. Everybody's shooting for the same goal, and that is a well-run loan portfolio, an institution that has its risk managed. Policies and procedures being kept current, everything from risk appetite to metrics that measure it, how well you document loan modifications, and how well you state in your policies and procedures what you will and won't do for not only types of loans, but type of collateral. These policy and procedures should be to the point of where they are basically maintained current monthly. It's not something to put on the shelf. I know we've all talked about, and I've talked about, we've all agreed for years, annual approval of a loan policy doesn't mean you don't change it annually. Changes can occur and should occur throughout the year and as often as possible. So when the examiners walk in, they ask for that, and you say, I've got a current one. This shows you what we're doing. So you're not making excuses because they're finding things you're doing differently than what's written on paper. Third-party service agreements, and I suspect 4th and 5th exist in many of your institutions, if not 6th. Seeing too many instances of where management of the third party has become a much bigger challenge. My old examiner hat told me, and I used to say this to bankers, manage those third parties as if they're a department of your bank. No different. You need to be responsible for everything that goes on. It is your bank that's going to suffer if they don't do their job. It is your responsibility to make sure they do. And this, whether it's the firm Clovis Walter or whoever, Walters Clovis, sorry, or whoever you're dealing with. And particularly when it comes to making sure you've got the right agreements and the right expectations, find the firm that is able to do what you need without you worrying about it, basically. Managing compliance risk, we've talked about, but in my recent conversation with an FDIC examiner who is a neighbor of mine, says this is a point that they're looking at closely, making sure during the COVID that people are being treated equally, just like they always should be, but now more particularly sensitivity to people's needs and how well you work with them and across the board, all customers. Loan collateral exception, the exception reporting, I won't spend time on it, but I've seen too many instances where reports on what is going on, in this case, collateral exceptions, let's say, it's become data-driven instead of analysis-driven. I strongly encourage you to take a look at your reporting. If you can do that, or you can influence it and say, hey, are we describing our situation, or are we just giving data to the committee and the board? Or are we describing what actually is the true risk with our collateral management process? And then last but not least, I always try to sell this one. I've seen, again, it's curious to me in this day and age, but I think there's still bankers who are afraid to speak with their examiners. If I were you and had not talked to my examiner at this point about their views, expectations about how they're going to look at you in this COVID world, that should happen. There's no reason why you shouldn't know what they are thinking, and if they don't want to talk, well, you've tried. But I have found in all the people I've dealt with over the years, particularly examiners, and their willingness to talk, they want to do things to help you. Makes their job easier, right? Makes your job easier. So why not? So good luck with that. And maybe at some point after this, you can start looking at trying to get that 69% figure up a little lower and the 41% figure a little higher. So hope that was helpful. I can tell you, in my experience, there's, I could go on about stories. Marina and I talked about some of the stories, but one of them is a bank years ago in Texas where the examiners pulled up and couldn't park in the parking lot because it was full of repossessed automobiles. I don't think you want that to be your parking lot. I've seen, and this doesn't necessarily apply to people here, but a floor plan arrangement where the dealer is sold out of trust. Clearly, examiners are going to jump all over that. The biggest and most frequent, I think, aspect that we're seeing, or I've seen even as a consultant today, is where banks still need to make sure compliance risk is at the top of their list. You've been doing credit for years, right? Compliance should be something else that is done as well as credit, but for some reason, it's a very difficult leap. If there's not intention by the board and turn to the top about compliance risk, by all means, that to me would be a high priority in related to collateral, repossessions, collections, anything that you're going to be dealing with the public. Compliance risk is huge. So with that, hopefully this is helpful.
This is really helpful, and this is a great insight. Here are kind of the things that I heard that really resonated with me. This is everyone's job, and if you do not, in your role, talk to your examiner today, it is all of our job to make sure that our collateral is perfected, that your exceptions are addressed. But I really like how you're talking about proactively managing risks and assessing portfolio health. Why do we care? And Bob, you talked about this a little bit already. We care because of the way the situation is right now. Going into the COVID times, we already had $1.3 trillion in loan and lease outstanding balances and debt, and we kind of had higher default rates in Q4 last year going in. People are experiencing hardship. We understand that coronavirus had profound impact on our borrowers. We also know that those 18 million that in May fell behind on credit card payments and auto payments, these people will require help, but we also see that long-term deferrals are coming to an end. We see payments extensions decline. I was on a call with a customer earlier this week who said we just can't help our borrowers for much longer. We also know that unemployment rate, while it did come down, the latest number is July. I'm sure August numbers should be published shortly, but 10.2% unemployment in July, down from 14%, but it's not coming down fast. And we understand that our borrowers will be struggling with potentially possible repossessions coming up. So Rick, I wanted to switch to you and talk about very practical guidance. Our portfolio today, I'm pretending to be a lender, has exceptions. What do I do?
Thank you, Marina. So we all know that the repossessions are coming. In the past, your institution may have been okay with exceptions exceeding 90 days, 120 until you actually perfect it. These days, this is going to create even more issues for lenders. If you're not properly perfected, trying to perfect it now is going to be a huge delay. Meaning, give you a couple examples. If you don't have a title and you just request a duplicate title, if you're not listed as the lien holder, that duplicate title is most likely not coming back to you. In some instances, you may not even know if you're listed on the title properly. You know, you want to ensure at this time that you are perfected properly. The main reason is there's delays from the DMV especially. We're seeing turnaround times that used to be days, now weeks. We're seeing DMVs put into place things that come first, whether it's a driver's license, and things that fall towards the bottom. It may be a duplicate title. We're seeing a lot of differences in this market today, especially around repossession, but exceptions should be key. Usually if your bank was acceptable to, maybe 10% of your total loans in automobiles were an acceptable percentage to risk, most likely those now are going to be scrutinized even more, as Bob said. And basically, you want to ensure perfection. Don't wait to the last minute to do this, as it's going to complicate the process. So a couple things. Sometimes you need an expert. Understand what your options are, making sure that you understand there's clear path to what you're trying to do. Understand also that turnaround time, in order for it to happen quickly, events need to start at different times. A good example of that is some lenders would wait until the redemption period or the time that the borrower can reclaim the collateral to start the title work. Well, these days, because of the delays at DMV, that process is going to take longer to get titles from them. Also understand there's challenges within the jurisdictions. Jurisdictions have very much tightened their requirements around various types of transactions, meaning they are, in the past, you may have been able to submit something, and if it didn't have a signature somewhere or you were missing something, a clerk would just accept it. Those days are most likely behind us right now, as we're seeing a crackdown. If it's not done properly, they're sending it back, which adds even more time to the process. We're also seeing changes in forms. DMV is changing forms across the board. Not every state, but some states. An example, we just did one state looking at the form again, and 2 days later, a new form came out from that state. So you can see it is definitely changing within there. Having the ability to have visibility into your projects, whether it's a company helping you with the exceptions, explaining the various steps you have to take in regards to maybe you need to do a Navitas search first to understand where the vehicle is even titled, to doing a VIN search to make sure you're listed on the title, to requesting duplicate titles, to having a clear title in your possession that you need to add your lien to. Having a partner that shows that visibility into your projects is very key. The other piece, with the influx of repos that are predicted for end of Q3, definitely Q4, there's going to be an influx. Today, you may have a staff that handles this. Imagine if you have all these exceptions on top of the influx of new orders you have to handle and the amount of time it's going to take you. So really understand your process today, look at these exceptions, and act now before a repossession happens. Maria?
Thank you. Sum it up for us.
Okay, so critical steps to take for vehicle collateral. As I had stated, address your exceptions now. You know, if it's 4% or 5% that are exceptions in your portfolio, most likely those are going to be the ones you're going to have to repossess later on. By going through that, you're going to expect delays. Account for the DMV backlog, delays in processing. As I had stated before, if you started the titling process after the redemption time period has ended for that given state, you may want to start the process of getting the title once you get the vehicle in your possession to reduce some of these delays. Few jurisdictions that we have seen is we used to be able to get a repo title back from a jurisdiction in about 3 to 5 days. On average now, that's almost up to 2 weeks in some cases even longer. Really focus on possibly outsourcing to a vendor that can handle all of these requests for you, as well as guide you through the process of how to rectify your issues with not being perfected correctly. Marina, I do have a couple examples, and recently in talking with a lender, and the reason this came up with them is they purchased a portfolio about 2 years ago from another institution. Somehow it got just put in a box somewhere within the institution. Now they're looking at it and they're understanding that the previous bank wasn't listed as the lien holder. They're not listed as the lien holder. The borrower has missed 3 payments now, and they're panicking to get these titles into their names in order for them to take the portfolio that they have back into their possession. The other thing is that we're also hearing from clients that, before they had, maybe 5% exceptions that exceeded 90 days. Those numbers are going up in talking with the customers. They're saying they're seeing now, due to the delays at DMV, if you rely on your borrower to go in or you had in the past, that those delays now are causing that 5% at 90 days to go up to 25% in some cases. So we're seeing the impacts holistically through the process from the beginning in titling all the way through trying to get rid of the asset once you repo it very quickly.
We are at the bottom of our time, at the end of our time, but we're not leaving you just to hang like that. Here are our emails. You can email Bob, you can email Rick, you can email myself with any sorts of questions if they arise, with any sorts of comments. We're here to help you. We're here to serve you. This is also our job to help you perfect and protect your collateral, follow the best practices of sound auto lending in these times of COVID. We really appreciate you spending this time with us. We appreciate your business. We appreciate your participation. Thank you, and thank you, my wonderful panelists today, Bob and Rick.